Ever thought about investing in the stock market and how intimidating it can seem? Stock market investing can seem like a daunting task for beginners, but with the right knowledge and approach, it can be a lucrative way to make money. The first step in getting started with stock market investing is to educate yourself on the basics. This includes understanding what the stock market is, how it works, and the different types of investments available. Investing in the stock market can be an excellent way to grow your wealth over time. However, for beginners, the world of stocks can seem intimidating. Here's a step-by-step guide to help you get started with stock market investing and begin your journey toward financial growth. Step 1. Understand the basics. What is the stock market? The stock market is a platform where shares of publicly traded companies are bought and sold. When you buy a share, you own a small part of that company. Why invest in stocks? Investing in stocks can offer higher returns compared to traditional savings accounts. Over time, the value of your investments can grow, especially if you reinvest dividends and stay invested long-term. Types of stocks. Common stocks give you voting rights and dividends. Preferred stocks offer dividends but usually don't have voting rights. Step 2. Set your financial goals. Determine your objectives. Are you investing for retirement, a down payment on a house, or just to grow your wealth? Your goals will influence your investment strategy. Assess your risk tolerance. How much risk are you willing to take? Stocks can be volatile, so it's important to know your risk tolerance before you start investing. Time horizon. How long can you keep your money invested? The stock market is best suited for long-term investments. If you need your money within the next few years, consider safer investments. Step 3. Educate yourself. Learn key concepts. Market orders versus limit orders. A market order buys or sells a stock immediately at the current price, while a limit order sets a specific price at which you're willing to buy or sell. Bull and bear markets. A bull market is when stock prices are rising, and a bear market is when they are falling. Diversification. Spreading your investments across different assets to reduce risk. Read books and articles. Books like The Intelligent Investor by Benjamin Graham and A Random Walk Down Wall Street by Burton Malkiel are great for beginners. Follow financial news. Stay updated with financial news from reputable sources like Bloomberg, CNBC, or financial sections of major newspapers. Step 4. Choose a brokerage account. Types of brokerage accounts. Traditional brokerages offer a wide range of services, including research and advice, but usually have higher fees. Online brokers, cost-effective and user-friendly, suitable for beginners. Examples include Robinhood, E-Trade, and TD Ameritrade. Opening an account. Compare fees, features, and services of different brokers. Provide personal information and fund your account. Step 5. Develop an investment strategy. Decide on your approach. Active investing. Picking stocks and timing the market to outperform benchmarks requires more time and research. Passive investing. Buying index funds or ETFs that replicate market indexes like the S&P 500. Easier and less time-consuming. Research stocks. Use fundamental analysis, evaluating a company's financials, management, and market position, and technical analysis, analyzing price charts and trends to make informed decisions. Diversify your portfolio. Invest in a mix of stocks from different industries and sectors to spread risk. Step 6. Start investing. Buy your first stocks. Decide how much money you want to invest. As a rule of thumb, don't invest money you can't afford to lose and think long-term. Dollar cost averaging. Invest a fixed amount of money at regular intervals, regardless of the stock price. This strategy reduces the impact of market volatility and lowers the average cost per share over time. Step 7. Monitor and adjust your portfolio. Regular checkups. Periodically, review your investments to ensure they align with your goals. Quarterly or biannual reviews are a good practice. Rebalance your portfolio. Adjust your portfolio to maintain your desired asset allocation. For example, if one stock grows significantly, you might sell some of it and reinvest in underperforming areas to balance your risk. Stay informed. Keep up with market trends and news that could affect your investments. Adjust your strategy as needed based on new information. Step 8. Stay disciplined and patient. Avoid emotional decisions. The stock market can be volatile. Avoid making impulsive decisions based on short-term market movements. Stick to your long-term strategy. Think long-term. Investing is a marathon, not a sprint. Focus on long-term growth rather than short-term gains. Learn from mistakes. Everyone makes mistakes. Analyze what went wrong and learn from your experiences to become a better investor. Once you have a basic understanding of the stock market, the next step is to set clear financial goals. This will help you determine how much money you want to invest, what your risk tolerance is, and what your investment timeline looks like. It's important to have a clear plan in place before you start investing to avoid making impulsive decisions that could lead to losses. Once you have opened a brokerage account, the next step is to start researching potential investments. This includes analyzing different companies, industries, and market trends to identify potential opportunities. It's important to do thorough research before making any investment decisions to ensure that you are making informed choices. When you are ready to start investing, it's important to start small and diversify your investments. Diversification is a key strategy for reducing risk and maximizing returns. By spreading your investments across different assets, industries, and geographic regions, you can minimize the impact of any one investment performing poorly. As you start investing, it's important to monitor your investments regularly and make adjustments as needed. This includes reviewing your portfolio, tracking market trends, and staying informed about the companies you have invested in. By staying actively engaged in your investments, you can make informed decisions that will help you achieve your financial goals. In addition to monitoring your investments, it's important to stay disciplined and avoid making emotional decisions. The stock market can be volatile, and it's easy to get caught up in the ups and downs of the market. By sticking to your investment plan and avoiding impulsive decisions, you can avoid making costly mistakes that could impact your long-term financial success. It's important to remember that investing in the stock market is a long-term strategy. While there may be ups and downs in the market, it's important to stay focused on your financial goals and not get discouraged by short-term fluctuations. By staying patient and disciplined, you can build a successful investment portfolio that will help you achieve your financial goals over time. In conclusion, stock market investing can be a rewarding way to make money, but it's important to approach it with caution and diligence. By educating yourself on the basics, setting clear financial goals, and staying disciplined in your investment approach, you can build a successful investment portfolio that will help you achieve your financial goals over time. Remember to stay informed, stay disciplined, and stay patient, and you can find success in the stock market. I encourage you to explore more passive income ideas on our channel and share your thoughts in the comments section below. Don't forget to like, subscribe, and hit the bell icon to stay updated on our latest videos. Thanks for watching, and happy investing.